As we move deeper into 2024, the United States faces an uncertain economic landscape, with warning signs pointing toward potential turbulence ahead. This video delves into the complex dynamics shaping our economy, drawing insights from Jamie Dimon, CEO of JPMorgan Chase, based on his recent interview with the Wall Street Journal. The Federal Reserve's current stance on interest rates amid mounting pressures sets the stage for possible economic repercussions. Dimon notes that the traditional levers of monetary policy have become less effective, with changes from the Fed taking longer to impact the broader economy. This slowdown is especially concerning as we look toward 2025, a year projected to see heavy refinancing activities. Consumers who benefited from long-term fixed-rate mortgages during the low-interest era of the COVID-19 pandemic might soon face a stark new reality. Businesses that refinanced at lower rates will also feel the pinch as these rates reset, revealing the full impact of the Fed's current policies. Moreover, this challenging outlook is compounded by growing fiscal deficits and geopolitical instability across Europe, the Middle East, and East Asia. These factors disrupt traditional monetary mechanisms, reducing their effectiveness and predictability. Dimon compares today's economic environment to the early 1970s, a period that seemed stable but quickly spiraled into turmoil by 1973. Join us as we explore these critical themes and how they could shape our economic landscape in the near future. Listen to Jamie Dimon's insights. It looks a little bit more like the 70s to me. I point out to a lot of people that things looked pretty rosy in 1972, but not in 1973. So don't be lulled into a false sense of security just because today seems okay. The 1970s were a transformative decade for the global economy, marked by upheavals that reshaped financial landscapes. This period began with the Nixon shock in 1971, when President Nixon ended the US dollar's convertibility into gold, leading to an era of floating currency rates and volatility in international markets. The decade also saw stagflation, a troubling mix of stagnant economic growth and high inflation, exacerbated by oil crises in 1973 and 1979. Dimon draws parallels between that turbulent decade and today's conditions, identifying several key areas of concern. Inflation and supply shocks. Today's economy faces inflation risks due to large-scale fiscal stimuli and ongoing supply chain vulnerabilities. The COVID-19 pandemic highlighted the fragility of global supply chains, and continuing geopolitical tensions could cause further disruptions. Geopolitical risks. The oil crises of the 1970s demonstrated how geopolitical tensions can trigger economic shocks with broad implications. Current tensions in places like Eastern Europe, the Middle East, and the South China Sea could similarly disrupt global trade and energy supplies. Economic policy. Response. The 1970s exposed difficulties in responding to crises with effective policies. Early attempts at wage and price controls failed to curb inflation and were unpopular. Today, central banks face the challenge of balancing inflation control without hindering growth in a complex global economy. Public sentiment and economic confidence. Dimon warns against being lulled into a false sense of security. The early 70s seemed stable, but quickly devolved into economic chaos. Maintaining economic confidence without fostering complacency is critical. Dimon's comparison to the 1970s serves as a cautionary tale, urging leaders and policymakers to navigate cautiously with awareness of both immediate and long-term risks. In his interview, he also paints a picture of the contrasting financial realities facing U.S. consumers. The consumer's in pretty good shape right now. Unemployment is under 4%, and housing prices, stock prices, and wages are up, particularly at the lower end of the spectrum. But this growth is largely driven by fiscal spending. which raises concerns about future inflation. Dimon's nuanced view reveals a divide in the financial well-being of U.S. consumers. On one side, many are experiencing prosperity, benefiting from low unemployment, rising housing and stock values, and increased wages, especially at the lower end of the income spectrum. This presents an image of economic vitality. However, Dimon highlights the troubling reality for the bottom 20% of income earners, facing inadequate wage growth, limited affordable housing, and broader socioeconomic issues, including health disparities and higher crime rates. This paints a starkly different picture of economic reality for many. Government fiscal spending further complicates this scenario. Consumer spending is buoyed by fiscal policies, but this has led to a deficit accounting for 6% of GDP. This reliance on government expenditure fuels growth, but builds a precarious foundation for stability, raising concerns about sustained inflation. This disparity between economic indicators and the lived realities of many consumers reflects a global pattern of uneven benefits. Despite signs of economic recovery, vulnerabilities remain, especially for those who do not benefit proportionally from growth. This uneven impact highlights broader economic and social challenges that may arise if these issues go unaddressed. Dimon's cautious outlook also includes concerns about rising interest rates to counter inflation. This could increase borrowing costs, dampening consumer spending and slowing growth, particularly affecting those in precarious financial situations. Dimon suggests 2025 and 2026 is critical, indicating that challenges for consumers could intensify if wage growth doesn't keep pace with these changes. This analysis underscores the need for a comprehensive understanding of consumer experiences across the spectrum. While some may feel secure in current conditions, many others do not, facing issues like affordability, health, and job quality. This uneven impact, if unaddressed, could lead to broader challenges, making economic stability more fragile than it appears. If you're enjoying this video, remember to subscribe to our channel, Cash Ops, for more content like this. Beyond these immediate concerns, Dimon also touches upon broader economic trends that may shape our financial landscape in the coming years. The global economy has become more interconnected, with international trade, currency markets, and financial systems influencing one another in complex ways. This interconnectedness amplifies both the potential for growth and the risks associated with instability. Dimon's insights highlight the importance of managing these interdependencies carefully. Policymakers and business leaders must balance short-term actions with long-term consequences to avoid triggering further economic turmoil. For instance, the relationship between fiscal policy and inflation remains delicate, with fiscal stimuli offering immediate support, but potentially leading to sustained inflationary pressures if not managed correctly. The evolving nature of global supply chains also plays a crucial role in shaping economic stability. The COVID-19 pandemic underscored how vulnerable these systems can be to disruptions, and ongoing geopolitical tensions pose additional threats. The potential for further supply chain interruptions, coupled with inflationary pressures, could lead to significant challenges for businesses and consumers alike. In conclusion, Jamie Dimon's insights serve as a reminder of the delicate balance required in today's economic landscape. The parallels to the 1970s caution against complacency, urging policymakers and leaders to maintain vigilance. Like the video, subscribe for more content, and let's continue exploring the economic challenges and opportunities ahead.